Amish Shah, Head of India Research at BofA Securities, on the conversation as well. Amish, so good having you. Thanks so much for taking the time out and being with us today. Really appreciate. And, you know, I was reading your note, Amish, wherein you mentioned that while you keep your year-end target intact, but you expect swings to the extent of 15%, either direction, 11% and 4% effectively from those targets, as markets adjust to emerging developments. There is one development that has happened over the last 24 hours. What impact does that have, Amish, to flows, to multiples, or other dynamics which may impact the market?
Good morning, Neeraj. So yeah, absolutely, tariffs is one of the factors that can drive sensitivity for markets, both in terms of earnings and valuations. So I would argue that, look, markets are currently trading at around +1 standard deviation, around 21.5 times. 50% tariff, currently nobody expects to continue. Most of the market participants believe that this is a matter of time. We would probably over time revert to 20 to 25% tariffs, and that's what markets are pricing in. But clearly, if 50% stays for longer, then we could have the 11% downside case that we are arguing for right now.
Got it. Okay. So, Amish, again, just trying to understand, because you look at numbers and timelines so closely, for the markets to start baking in 50%, is there a time limit? Let's say that if indeed no resolution comes in for the next 60 days maybe, or 30 days, or 90 days, then you in your models as well start factoring in a 50% tariff impact both on earnings as well as multiples.
Sure, Neeraj, so basis the conversations with investors, I think everyone's expecting this issue to get resolved within a month or two. But anything beyond that, I think markets will start to price it in negatively.
Amish, hi, Alex joining in, and I find that interesting, right? Because there's so much back and forth coming through. And in the meanwhile, on the domestic front, you have moves that the government is taking to perhaps mitigate some of the impact for these individual companies and sectors, and equally to bolster domestic growth. I wonder what you think about the implications, for example, of the two-rate structure for GST, the CRR cut coming through on the monetary front. You have a possible rate cut coming through maybe towards the end of the year, 1 or 2. What are the impacts of all of that?
Positive directionally. So clearly, I think government is doing the right thing. Their policy, both in terms of fiscal as well as monetary, is to stimulate growth in this environment. We've seen a total of $48 billion of consumption stimulus so far, which is about 120 basis points of GDP. If you think about it, the additional subsidies given out over the last 12 months, mostly by the state government, some from the center, is $24 billion. Over and above that 24 billion, you had $12 billion come in through the tax cuts, direct tax cuts that were announced in the budget of February. And then possibly our expectation is that there will be another $12 billion coming in the way of GST cuts. So $48 billion, it's about 120 basis points of GDP. Over and above that, there will be some savings in the form of lower EMIs from the lower rates that we spoke about, plus there'll be more liquidity into the system. So there is about, all put together, about 150 to 170 basis points of stimulus, depending on which way you calculate it. And that's the right thing to do. There is a need to stimulate growth right now. Government is going all out and stimulating that growth. Coming back to markets and implications, however, we think that the markets have more than priced in that recovery. And we think that the recovery is likely to be shallow in comparison to the street expectations. And therefore, arguably, earnings cuts will continue.
There is usually, Amish, a pretty long lag for some of these aspects to come through. And as you pointed out, directionally, it's positive. I'm just wondering, when you anticipate some of these factors to reflect in earnings, do you only see it at the start of the next financial year? And I'm asking about which of the sectors that you see will benefit the most. Everyone's focused on consumption, but if you can splice that for us.
Sure. So Alex, different sectors, different answers. You're right that in some cases the rate transmission mechanism takes time, but the stimulus measures can bring in immediate results. To answer it in short, we think any consumer sectors that has a benefit of leverage and relatively discretionary is likely to see a growth uptick earlier. So we are currently excited about consumer durables, building materials, real estate, REITs, travel and tourism, and some quick commerce, jewelry stocks. So that is a pack of consumption basket that we are positive. We were always positive on the four-wheelers and the commercial vehicles. We continue to be positive there as well. GST cuts only helps these sectors, but there were tailwinds for growth for these sectors anyways. But the rest of the consumption categories like staples, footwear, QSR, textiles, apparels, two-wheelers, those are the baskets where we think that the growth recovery will fall short of expectations, and therefore we continue to stay underweight on those subsectors within consumption.
And Alex, Amish, and we'll come back to sectors, but just one quick numbered question thrown in. Based on your earnings growth estimates, because I heard you mention in the previous answer to Alex that you expect earnings cuts to continue. So based on your earnings estimates for FY26 or FY27, the fair value, I'm presuming, could be lower if indeed tariffs stay higher. Is there a so that you explain, is there a fiscal risk that comes into India because the stimulation that the government has done or might need to do to counterbalance the impact of slowing growth?
So absolutely, Neeraj. So look, putting some numbers into perspective, Nifty delivered 5.5% earnings growth in FY25, which is the year gone by. Consensus was expecting that on a low base of 5.5, Nifty earnings growth could possibly be 22% in F26. Over time, that 22% has come off in their expectations to 11%. We are even lower. We think that 11 is also a tall ask. We think that FY26 Nifty earnings growth will be 7%. Similarly, for FY27, on the base of 7% growth, in FY27 we expect 11% growth. Consensus is expecting 15% growth, which is to my point, therefore, that the consensus cuts continue. And this is not even taking into account the impact of tariffs. If the tariffs stay higher for longer, then clearly it impacts India's fiscal math and therefore corporate earnings growth as well.
Amish, clearly shows that if indeed the tariffs were to stay higher, then your own estimates of 7 and 11%, which are also quite low, might actually go lower, and presumably your target, which of course the note was written on 12th August, the one that I have, so maybe you've changed the targets now, but those targets will also come under revision.
Absolutely. So we have not changed our targets, Neeraj. Our base case is that the 50% tariffs don't hold for longer, in which case 25,000 holds. But we have put a sensitivity in that same note to say that if the tariffs were to continue for longer, then there is a 11% downside to our target.
Okay. Amish, good morning. Hiral this side. You're talking about an 11% downside to your 25,000 target. And if the tariffs don't hold, probably you could even see a 4% upside to it. Is my understanding correct on the upside as well, the bull case?
That is correct. So think of it like this, that the base case is 25,000. The best case can be 4% upside to that. The worst case can be 11% downside to that.
Okay. So with the 4% upside, if that holds water with the dynamics around, which are the sectors that you would actually potentially look at for that 4% upside to come in?
So Hiral, we think that currently investors should have a mix of some cyclicals, some defensives, some consumer discretionary and some capex. So to articulate it, we are currently focused on rate-sensitive domestic cyclical sectors. There are 5 of those that we like, which includes financials, REITs, real estate, commercial vehicles, and passenger vehicles. These are the cyclical sectors that we like. There are certain consumer discretionary subsectors that we like, which, as I was arguing, is consumer durables, quick commerce, building materials, and possibly jewelry and travel and tourism. So that is what we would keep within the consumer discretionary space. And within capex, very selectively, we would only have defense, shipbuilding, and power transformer subsegment related stocks. And then, given our view that the markets may not give you much returns, we also want to have some defensive sectors in our portfolio. And as a result, we are optimistic on hospitals, telecom, power utilities, gas utilities, and we have recently upgraded IT sector as a tactical buy. So that is what I would look to on. Most of the sectors that are linked to the external world or global growth is where we are underweight. We are also underweight on a larger pool of consumption basket because we think the actual consumption growth will fall short of expectations. And we are negative on broad capex space as well, including cement.
Found that note quite interesting, the underweight to overweight shift, and you called it tactical on IT. Can you take us through a little bit on that? What is driving this? And is this a valuation game, or is this expectation that maybe the earnings trajectory that has been penciled in is a little pessimistic and things will improve? And of course, everybody's talking about the Fed rate cut and if things are better towards the end of the year.
So Hiral, think of it like this, that as we were discussing so far, there is a lack of earnings visibility in the environment currently. So IT, we are not arguing for acceleration to earnings growth, but the weaker earnings growth in the IT sector is now very well understood. And the good news is that at least that weaker earnings growth has more visibility. And in the meantime, the valuations for the sector has come off quite meaningfully. Positioning of these sectors across domestic and foreign investors is very light. And in an environment where every investor will look for earnings visibility, we think IT is a better space to be. And the short squeeze in the sector itself could potentially give the tactical rally that we argue about. So it's not about earnings acceleration or earnings upgrade, but visibility of the weaker earnings growth is enough right now for the IT sector to rally.
Amish, one final question really before we thank you. Yeah, let's work with the hypothesis that you started off the conversation with, that the tariff picture gets resolved. And we've seen the measures done by the government, etc., all of that. You still believe a 4% upside at max because of the 7% and 11% earnings growth. What can surprise you positively, or what is it that could lead to a positive surprise for you? Because you seem to be conservative right now, right?
So Neeraj, I think government has started talking about a variety of reforms. Now that reforms could be legislative, which the markets will really appreciate. Reforms could be about improving ease of doing business, which actually helps businesses on the ground, but unlikely that the markets will pay up valuations for that right now. So depending on what reforms does the government do and what impact will have on the structural GDP growth of India and therefore corporate earnings, presents an upside case. But we'll have to watch out for as those reforms gets rolled out.
Very quickly, Pushu, I know we are getting out of time, but just very quickly, because I heard you say that ease of doing business may not have as much impact, but legislative reforms are what market may appreciate. A sample or one or two things that, if done, could actually help the market mood?
So reforms linked to all factors of industrial production. This is land, labor, power, and judicial. So a combination of these 4 reforms, or at least 2 out of those 4 reforms, I think is something that the markets will want to pay up in terms of valuation multiples.
Got it. Okay. Amish, always good talking to you. Thank you so much. Today was no different. Really appreciate your time.